Welcome back to Trading Feeling Mind, where we decode the hidden language of the charts and master the art of trading. Have you ever wondered why your stop loss is hit precisely before the market moves exactly in your predicted direction? It feels like the market is personally watching your trades, waiting for you to enter so it can take your money. But the market is not random. It is a highly efficient machine designed to transfer wealth from the impatient to the patient. Today, we are going to learn how to stop trading like retail victims and start thinking like the institutional smart money. To understand the market, you must first understand liquidity, which is the fuel that powers every single significant price movement. Big banks and institutions cannot simply click a button to buy. Their orders are too large and require massive liquidity. For them to buy, they need thousands of people selling. For them to sell, they need thousands of people buying eagerly. Retail textbooks teach us to sell at double tops and buy at double bottoms, placing our protective stops just above. Those stop losses are actually buy orders waiting to be triggered. The banks see this cluster of orders as free fuel. This is what we call a liquidity sweep. The price manipulates the highs to trap buyers before reversing in the real direction. While the retail trader is panicking about a breakout that failed, the smart money trader is preparing to enter the trade. Now let's look at market structure. We need to identify the true trend to ensure we are trading with the flow. A break of structure, or BOS, confirms that the trend is continuing. But be careful. Not every break is a true break. Smart money leaves a trap called inducement. This is a short-term low that encourages early buyers to enter the market prematurely. The market will almost always return to sweep this inducement level before it taps into the real point of interest. This brings us to the order block. This is the specific candle where institutions placed their final positions before the big move. To find a valid order block, look for the last down candle before an up move that created a structural break. Crucially, a high probability order block must have an imbalance or fair value gap just above it, showing aggressive buying pressure. So the sequence is structure break, leave inducement, price returns to sweep inducement, and finally taps into our order block. Warning, not all order blocks work. If you blindly place limits on every zone, you will lose your account very quickly. An order block without liquidity engineering before it becomes the liquidity itself. The market will just run right through it. We call this the smart money trap. It looks like a valid setup, but it exists only to induce more traders to enter. Let's apply this theory to a real chart on gold. We will analyze the price action step by step to find an entry. First, always start with the higher time frame. Here on the 4-hour chart, we see the market is clearly trending to the downside. Now we drop to the 15-minute chart to refine our entry. We are looking for a continuation of this bearish narrative. We identify that price has just broken the previous low with a strong body close. This confirms our bearish structure. We look up to find the origin of this move. Here is a clean supply zone with a clear imbalance below it. Notice this small resistance level just below our zone? That is the inducement. Retail traders will sell there, placing stops above. We wait patiently. We want price to rally, take out those early sellers, and tap into our premium supply zone. Once price hits our zone, we do not enter blindly. We drop to the 1-minute time frame to look for a confirmation setup. On the 1-minute chart, we wait for a change of character. This is the first sign that the bulls are exhausted. After the change of character, we place our sell limit at the new M1 order block, keeping our stop loss tight. This confirmation entry allows us to have a very small stop loss, giving us a massive risk-to-reward ratio potential. The trade is triggered. Because we waited for liquidity to be swept, there is no reason for price to go higher. Our target is the weak low at the bottom of the structure. We know price is likely to gravitate towards that liquidity. We hold the trade with confidence. The market logic is playing out exactly as planned, driven by the institutional order flow. So to recap, identify the structure, wait for the liquidity sweep, and confirm the entry on a lower time frame. The biggest mistake new traders make is chasing the price. They see a big move and jump in right before the reversal. Trading is 90% waiting and 10% execution. You must be like a sniper, waiting for the price to come to your zone. If a setup does not meet all your criteria, you must let it go. Protecting your capital is more important than profit. Understand that price moves from internal liquidity to external liquidity. It collects orders inside the range to break out of the range. The timeframes are connected. The noise on the 1-minute chart is actually building the structure for the 1-hour chart. Even with this powerful strategy, you must manage risk. Never risk more than 1% of your account on a single trade. Smart money concepts will not save you if you over-leverage. The market can remain irrational longer than you can remain solvent. Now let's look at a buy setup. We want to see a bullish market structure with price making higher highs and higher lows. We identify a strong demand zone. This is the area where institutions stepped in to buy heavily, leaving an imbalance behind. We want to see a corrective pullback. If price crashes down too fast, we might be cautious. We prefer a slow approach. Notice how price creates a trend line of support? This is engineering liquidity. Retail traders are buying this line, placing stops below. The market smashes through the trend line to grab all that liquidity, which provides the perfect fuel to launch price upwards from our zone. We enter the buy. Because the sellers have been trapped, the path of least resistance is now to the upside. The hardest part is holding the winning trade. Do not close early out of fear. Trust your analysis and your target. Trading is not gambling. It is a business of probability. You are the casino, not the gambler, if you follow the rules. You must backtest this strategy hundreds of times. You need to build confidence in your eyes to recognize these patterns in real time. Keep a trading journal. Record every win and every loss. Analyze why a trade failed. Was it the market or your discipline? Be aware of high-impact news events. These can destroy technical setups in seconds. It is often best to stay flat during news. If there are no setups today, do not trade. Preserving your mental capital is just as important as preserving your financial capital. Look for confluence. The best trades happen when structure, liquidity, and time of day all align to tell the same story. Pay attention to sessions. The London and New York sessions usually provide the volume needed for these smart money setups to play out. Often, the Asian session creates a range that becomes liquidity for the London session to sweep. Watch for the Judas swing. Advanced traders can combine these concepts with Wyckoff schematics to further increase the precision of their entries and understand the cycle. Your goal is consistency, not a quick fortune. A consistent trader can scale up their capital and achieve true financial freedom. You are not alone in this journey. By watching this, you are joining a community of traders who seek the truth behind price. You will have losing streaks. It is inevitable. But if you stick to the rules and manage risk, you will survive and thrive. Remember the steps. 1. Identify your supply or demand zone that broke structure and has a clear imbalance remaining. 2. Wait for the market to sweep liquidity. Do not be the first one to enter. Let the retail traders get trapped first. 3. Confirm the entry on a lower time frame or place a limit order if the setup is high quality. Then, execute. Mastering these concepts takes time, but the reward is a skill that can generate income from anywhere in the world forever. If you found value in this video, please hit the like button. It helps us reach more traders who need this information. Check out our other videos for deep dives into market structure and trading psychology to complete your education on this system. Remember, the market is always right. It is our job to listen to what it is telling us, not to predict it. Every day is a new opportunity. Leave yesterday's losses behind and focus on the present moment and the current chart. Discipline is the bridge between your goals and your accomplishments. Stay disciplined, stay focused, and trust your trading plan. Please remember that trading involves significant risk. This video is for educational purposes only and is not financial advice. We are dedicated to helping you find your edge in the markets. Keep learning, keep practicing, and never stop improving yourself. Thank you for spending your valuable time with us today. We hope this knowledge brings you closer to your trading goals. We will be back soon with more advanced concepts and live trade breakdowns. Make sure you are subscribed so you don't miss out. Until next time, trade safe, trade smart, and always keep your feelings in check. This is Trading Feeling Mind. May the trend be with you. Good luck on your charts this week. See you in the next episode. Take some time to review your charts now. Try to spot the liquidity traps we discussed today. Practice makes perfect. If you are struggling with market structure, the video on the left will clear up your confusion instantly. Or if you need help with managing your capital, click the video on the right. It is a game changer. Goodbye for now. This has been Trading Feeling Mind, signing off.